Hello and welcome everyone. My name is Peter Robinson and today we have got Felicity Dean who's going to talk at the meetup about crypto and taxation. And it's going to be a really interesting talk, so I'll hand it straight over to you, Felicity. Please introduce yourself before starting though.
Absolutely. Well, thank you so much, Peter. It's lovely to be here presenting again. It's been a while since I've presented with the consensus. So yeah, wonderful to be here. Thanks for all coming along. Hopefully I'll keep it nicely interesting. I just want to start by acknowledging the traditional owners of the land. I acknowledge the Turrbal and the Yagara people as the First Nation owners of the lands where QUT now stands, and actually I'm presenting from my home, but it's the same, traditional owners. So I wish to pay respect to their elders, laws, customs and creation spirits. These lands have always been places of teaching, research and learning. And the Aboriginal and Torres Strait Islander people play a very important role within the QUT community. So just to introduce myself, my name is Felicity Dean. I'm from the Queensland University of Technology. And so from that introduction, you can see that I am not actually a taxation professional. I do teach tax and I really look at broad ideas of taxation, but I don't administer any tax law. So there may be some questions that you have that are more practical that I may not be able to respond to. In which case I'll direct you to go and consult with somebody who is a taxation professional. And just on that, I actually get my tax done by somebody, but do enjoy researching in these general areas. And I have a particular interest in looking at crypto taxation. I think I don't know what got me interested in crypto taxation. Certainly wasn't from making hundreds of thousands of dollars in it. But it just seemed really interesting. It seemed to be something that could potentially be missed by the tax system, but I can assure you that's not the case in Australia. And so on that, I'm going to be looking particularly at Australia. I have looked at the US in the past and the rules are similar, although the rules around capital gains are slightly different there. So if you're dialing in from another country, I'd suggest that you go and consult somebody locally about taxation. Of course, it's different in every jurisdiction. So some of the things I'm going to be talking about today, I'm just going to be talking about markets and money very, very briefly. I'm really not going to touch on that in any detail. My master's student, Simeon, had presented, I think it was 2 weeks ago, and Peter will probably confirm that, on central bank cryptocurrencies. And so if you're interested, I know the YouTube of that is up. And there's also so many good books about money and crypto and digital currency that I'd encourage you to potentially go and have a look at those if you're interested in the topic. So like I said, I'm going to potentially be talking about things in a very general sense. And I just wanted to start by touching on markets. I could spend a lot of time talking about money, its purpose, how it's taxed, but I don't think that would be terribly interesting. And like I said, it's been done far better than I can do it here. And yeah, like I said, go and have a look at that YouTube that Simeon presented, I think it was 2 weeks ago. But just as a starting point, so money is really a necessity. It was introduced as a necessity to overcome this problem of the coincidence of wants. So as this slide indicates, bartering works quite well when you do have a coincidence of wants. So you've got two people that effectively one wants what the other one has, and you can have a negotiation quite easily there. But where there is not that coincidence of wants, which is of course going to be the case in a society as complicated as ours, then you need something that allows these parties to trade. So this seems a little bit off topic, but markets and bartering, they're relevant to taxation, particularly when we consider the different ways that transactions are taxed, which is really what we do when we consider GST. It's really about the taxation of the transaction. So in terms of taxation of the individual and income tax is associated with the taxation of money or money's worth, which effectively means that something is convertible to cash. which I think it is reasonably fair to say that crypto is. So when you're thinking about income taxation, crypto is likely going to fall within that definition of being money or money's worth. So if we stick to bartering in a specialized society, it can become a very, very long chain of exchanges. And in each step of that chain, you're going to have a negotiation, which in economics terms is going to be a very inefficient process. And so this is where money is needed. And that way negotiation can occur in a much more efficient term. So this is where money comes in, and potentially where you can start looking at crypto as well. So some of the requirements of money: it needs to be light, it needs to be durable, it needs to be easy to identify and hard to forge. It's usually indicative of work that you've done to create something of value. Often a token can be used in place of an item. And if you, like I said, if you consider some of those books around the history of money, you can see that certificates from goldsmiths was an example of a token that was used in place of gold itself to save you from dragging around these big, heavy chunks of gold, of course. And this led to fiat money, which is the type of money that you consider we use most of the time today. And fiat money does not represent anything specific at all, except trust and stability. And trust is really a factor in, it's really a factor of any money as a result. Even when you consider the blacksmith and gold tokens, there was still it still required some trust. You still needed to trust. If you were holding your gold with that blacksmith and you took your token or your certificate in response to that, it still did require some trust. And this is also how we get floating currency, which is also what Bitcoin is. As a cryptocurrency, it's a floating currency. So floating money is not tied to anything specific. It's not representative of anything. So it's not linked to gold in any way. So that's where cryptocurrency is quite similar to fiat currency. Sorry, my slide's not moving. So that's all just a bit of background information. And so now I thought I'd get into really what the law actually suggests. So digital currency has been defined in Australia in relation to different types of taxation. So the recognition of the similarities in cryptocurrency and in money, as we've traditionally identified it, this led to the evolution of the term digital currency. And this has led to some legislative changes where digital currency was defined to include cryptocurrency generally. So in Australia, digital currency has been defined reasonably broadly, with examples provided that naturally captures things like Bitcoin and many types of altcoins. I won't say all of them. So things like Ethereum and Dash, it captures those. So despite this broad definition, it's likely that some tokens or even some of these initial coin offerings, they may sit outside this definition. So in particular, one of the features you can see from the slide is that particular digital currency must be usable as payment for any type of purchase, and it must not entitle the rights holder to any privilege to receive anything else. So this was all brought about. This wasn't, of course, done by the ATO. They basically sort of threw their hands up a number of years ago. I think it was 2014. This definition was made clear in 2017, but certainly around 2014, the ATO said that they shouldn't have a role in determining whether digital currency should or should not be treated as money, that such decisions were a matter for government. And so that's where this was brought about, and was particularly relevant to the GST legislation, which I'll talk about towards the end of the presentation. So things that are not digital currency, and I've taken this directly from the ATO website. So they're not considered to be digital currency for GST purposes. So loyalty points provided by retailers, for instance, currency used online in multiplayer games. I actually have no idea what that is, and I should have asked my son about it before I was speaking to you all. And also digital currency with value based on something else, that gives an entitlement or privilege to something else, it's not going to fall under this definition of digital currency. So that brings me now to really some of the practicalities of what I wanted to talk about, which is cryptocurrency and the ATO, how it's essentially dealt with by the Australian Taxation Office. And look, I'll apologise if this is a little bit simplistic. Often when I'm talking about taxation and crypto, I sort of need to start by explaining what blockchain actually is. And of course, I don't have to do that here. But if this gets a little bit simplistic, I apologise. So a cryptocurrency is a subset of digital currency. Digital currency is broader than just cryptocurrency. So cryptocurrency is, of course, it's a digital or virtual currency. It's secured by cryptography, which some would say, or it appears to be nearly impossible to counterfeit or to double spend. So cryptocurrencies are systems that allow for secure payments online, which is denominated in terms of virtual tokens. They're represented on the ledger, of course, as entries internal to the system. So crypto refers to the various encryption algorithms and cryptographic techniques that safeguard these entries in the ledger, of course. And I don't know anything about that because, as I've mentioned at the start, I'm a legal academic and have very, very little understanding of all of the technicalities of it all. So, of course, I've already mentioned that fiat currency is a currency that the government has declared to be legal tender, but it's not backed by a physical commodity such as gold or silver. And that's where it's really quite similar to cryptocurrency, or most cryptocurrencies. So I've provided a couple of dot points on the slide, and that's sort of to prompt me to give a bit of an overview about how cryptocurrency and taxation works in Australia. And I'm going to go into each of these in a little bit more detail as I move through the presentation. But in Australia, most transactions involving cryptocurrency will result in some form of tax liability. So its precise treatments and the reporting requirements are going to depend on a number of things. And it usually comes down to a case-by-case basis and looking at the taxpayer themselves. It also depends on how it's derived, how it's used, and how it's disposed of. So for instance, cryptocurrencies often involve that initial mining transactions. Now, in these circumstances, most miners will need to declare their profits as ordinary income. So the value to be declared will reflect the fair market value of the cryptocurrency at the point of mining. So once the coin is used, another taxable event is likely going to be created in the form of the disposal of a capital gains tax asset. Now, this is often the case. It's not always the case. I'm going to go through this in a little bit more detail. So in these instances, the ordinary rules of capital gains tax, or CGT, will apply here, particularly if it's been held for an investment. So there are some things that will be relevant to the taxation of cryptocurrency, for instance, how a person's transacting with it, how they intend to use it, and how long they've held it. And some of these rules are just a little bit fuzzy with the ATO, and I'm going to touch on them, give you my understanding of them. But like I said, if you want more precise advice, then I'd encourage you to go and meet with a tax professional, particularly one who deals in cryptocurrency. I don't know if there's many of those people out there, but yeah. So the way it's taxed is going to depend on how it's dealt with in the hands of the taxpayer themselves. It's not going to be the same across the board. And like I said, some of the rules are a little bit fuzzy, and it makes it slightly difficult to draw a one-off conclusion in all instances. So just a bit of a general slide, taxable events. So taxation requires that there's a taxable event as defined within the legislation. So when Bitcoin was created back in 2009, it was outside the understanding of existing tax law. So there were no taxable events associated with it. It was probably, although if you really looked at it, probably would have been likely to be considered property at the time. and there would have been transactions that should have had tax paid on them, but perhaps weren't. So a lot of commentators,
but it's second hand, so you don't have to.
So some commentators suggest that we are all a bit behind in regulating this, and that the way that it's been handled is not necessarily optimal. But in Australia, I'd say they've been reasonably quick to put out some tax rulings, although I don't think they had tax rulings until 2014. And I'm not sure if anyone has actually, it would probably be more likely. I'm not sure how many taxpayers have been fined for not paying their taxes on their crypto. I'm sure that there's been a number of people. I'm just not sure how many, but it might be an interesting research project to find out how many people have been fined, particularly prior to those taxation rulings in 2014. So in Australia, we've got this self-assessment system. So it's not an excuse to say, well, hang on, you didn't tell me that I had to pay tax on this. It's our responsibility as taxpayers to actually know when we need to be paying tax. And so it's definitely something that's likely to have occurred prior to those 2014 rulings, but I'm not entirely sure if it did. So moving on to specific circumstances and beginning, I'm going to go through 3 examples of people and how they interact with crypto. I'm going to go through miners, traders, and investors. So miners will need to pay tax on any crypto that they mine if they are doing it as a business. So deriving Bitcoin through mining will be a form of income if it is something that is more than a hobby. And I don't know that many people can claim to have a hobby of mining Bitcoin. But some of the things that indicate that something is a business versus a hobby will involve record keeping, a profit-making motive, which I think is the only fun to be had in mining Bitcoin, but please correct me if I'm wrong, and also some frequency in it. So if you had a one-off, if there was one opportunity, and like I said, I have no idea how to mine Bitcoin, but if you did it once and made money from it once, then you might be able to claim that it's a hobby and not a business, and therefore may not have to pay income in this form. However, even then, you would still have to pay capital gains tax. And of course, if you are running a business of mining Bitcoin, you do have the benefit of being able to claim deductions upon it as well. So moving on and looking at traders. So a trader and an investor are 2 different things, and these transactions are dealt with slightly differently, and perhaps those reasons will become obvious as I talk about this. So a trader is very, very active in crypto as a means to generate income, and is again operating from a business setup. So if you're running a crypto trading, forging, or mining business, regularly buying and selling for short-term gains, or running a crypto exchange, the ATO would tax you as a trader as opposed to an investor. So the profit's going to be taxed as ordinary income. And in these instances, you would not have to work out the gain on each and every trade. So the crypto would be considered as trading stock, and there would be some specific rules to work out what your trading stock would be at the start of the income year as compared to the end of the income year. And most applicable here would likely be the market value. And I was thinking it could potentially be quite tricky around this. And again, this is not something that I've looked at in any detail, but if you're looking at first in, first out, or last in, first out principles with cryptocurrency, it could get quite messy, treating as a trading stock. But if you're just looking at market value at the start of the income year and market value at the end, it would be far less messy, although maybe not the optimal taxation way of doing it. So I imagine there would be different ways if you were dealing specifically in taxing of crypto that you could optimize or minimize somebody's taxation without breaching any rules. Okay, so the other category that is applicable to most people involved in crypto are investors. So an investor is just that. They're an individual. They're investing in a future return. They buy and they sell crypto as a personal investment, as their stock, with the goal of gradually building wealth over an extended period of time. So the strategy is to buy and to hold, and the profit is made from these long-term capital gains typically. So most Australian crypto users fall into this category, and the transactions are therefore going to be subject to capital gains tax. So CGT liability will also extend to those who purchase and dispose of crypto through an exchange, and presently each disposal, including an exchange for different cryptocurrencies such as Bitcoin to Ethereum, will result in a liability for taxation. So each disposal, even if they're just trading it, not intending to trade it to fiat currency, it's still going to be a liability for taxation. And I've heard some horror stories about the number of trades people have made without realizing this, and yet still being investors, and having to keep records for each and every one of those trades, because each of those transactions is going to be a separate and reportable event. Okay, so some basic concepts around CGT, and again, I apologize if this is a little bit simplistic. So your assessable income, of course, includes your capital gain for the income year, because this is known as statutory income, and that's captured by the income tax legislation. That's your statutory income is included in your assessable income in much the same way as ordinary income is. However, when it comes to capital gains, you cannot deduct a net capital loss from your income just for any income year. You can only use it to offset capital gains for either that year, or you can roll it over until you can offset the entire amount of that loss. So your capital loss is not going to be a deduction. It is it's to carry forward until you have a capital gain to offset it against. So I think I've already touched on this sufficiently. Record keeping woes for investors. For traders, perhaps it's going to be a bit of a better story, but I imagine record keeping may be difficult. I'm not in the position where I've had to declare any cryptocurrency gains on my taxation as yet. So I'm not quite sure how difficult it is to get records associated with your crypto trades, but apparently this is one of the concerns with this form of taxation of it. But some good news, although I don't know that it's terribly good news, because it doesn't really apply to many people. So there is a little bit of a loophole in Australian taxation when it comes to cryptocurrency. So this does require that the ATO look at your specific circumstances, and it decides if you are holding cryptocurrency as an investment, or if you are holding it just so you can use it to buy things. Because of course, we've already identified that it is digital currency. It can be used in exchange for purchasing things. And if that's your purpose in holding it, so for instance, we've all heard the example of the person who's gone out and used Bitcoin to buy pizza. If your whole point in holding cryptocurrency is to go out and purchase things for your personal use, so it doesn't have to be pizza, it can be any form of commodity, then you're not necessarily going to have to pay tax on it. So if you are holding crypto for your personal use, then the capital gains tax liability is waived in certain conditions. So it's not just the nature of the property that's going to impact on this classification. It's really going to be looking at the circumstances around the person obtaining the crypto, how they've used it, and the objective intentions. So really understanding somebody's intention in buying crypto is going to be difficult. It's going to be those objective circumstances that they're going to take into account. So if it is not acquired for profit-making purposes, but for use in the purchase of personal items, then the ATO agrees the digital currency will be considered a personal use asset. So this means that any gains made from an acquisition purchase less than $10,000 will not result in a capital gains tax event. So it's completely disregarded in those circumstances. But I'm not sure how many people are going to be able to claim at this point, perhaps, in the future, but at this point, how many people genuinely use cryptocurrency for personal reasons. And the other thing is the ATO is going to have a look at all of the circumstances surrounding it. And there are other rules that apply for personal use assets that may not be optimal. So for instance, you can disregard any capital gain where you have a cost base of $10,000 or less. However, any capital loss is completely disregarded. So if you end up making a loss, you don't actually get to carry that forward and offset against other capital gains. So the things around this that are a little bit fuzzy, that I think are a little bit fuzzy, that I've not seen clarified anywhere, and please feel free to let me know if you have. So the ATO is going to look at how long somebody's held it. So you can't just go out and buy crypto for less than 10,000, sell it after 6 months, particularly if, it was a 6 month, like the start of this year, of course, where it went up exponentially. Sell it after that time and say, well, I was actually holding it, and then go and, buy yourself a few pizzas with it. That's not going to be something that the ATO says, oh, that's fine. We completely accept that. What they're going to look at is how long you've held it. They're going to have a look at, the objective circumstances surrounding the purchase of it, what you did end up purchasing with it, and how quickly you purchased that. And the longer you hold it, the less likely it's going to be accepted that you've held it as a personal use asset. Usually the disposal would have to be very, very quick for it to be considered to be a personal use asset. Okay, but if we are talking about capital gains, there are some rules that align with getting a discount as opposed to just declaring the entire amount as income tax, but there are some rules around that. For instance, in order to get your 50% discount on capital gains, you have to hold the asset for a year or more. So if you are trading, you do need to hold on to that initial purchase for a year or more. Otherwise, you're going to have to declare the entire amount as your capital gain in that particular year. Okay, so that's some very general ideas around the taxation of cryptocurrency in general. And I did mention to Peter that I wanted to talk about non-fungible tokens because it became a little bit of an interest of mine. So it's obviously been a little bit of a craze of late. And the difference for those of you who were listening at the start around digital currencies, there's going to be an issue with this being considered to be digital currency. Because this type of token, first of all, it is unique, being non-fungible. It cannot be exchanged for any other type of NFT, and it can have a different value to another token of the same type. So it's not going to be considered digital currency, and that could have GST implications. So again, sorry if this is simplistic, but a non-fungible token, it's a unit of data stored on a digital ledger. They're unique and therefore they are not interchangeable. NFTs are used to represent ownership interest in something that's tangible or intangible, even where that asset is stored outside of the digital ledger. And again, the tax treatment of the NFT is going to depend on your use and your reasons for holding it and transacting with the NFT. So again, you may pay tax on an NFT if it does in fact go up in value. I'm not sure if that actually occurs. But you can pay under the capital gains tax regime. You can pay on a revenue account as trading stock if you use it somehow in your business, if it's part of a business or a profit-making scheme. And depending on the terms of the NFT smart contracts and the rights that it grants, it could be a combination of any of these. So you may have to declare it as business income, of course, if you're an artist and you use an NFT to sell a piece of digital art. That initial sale is going to be declared as income, of course. Subsequent purchases, they could have some tax implications depending on how they use it. Could be considered a personal use asset in certain circumstances. So for a person who's buying it and they use it for personal reasons, the ATO has used an example of viewing an asset at a party with your friends. And the idea is that once you've done that, it's a disposal of the NFT, I suppose. And at that point, you won't have to pay any tax on it if it's been used entirely for personal reasons. So that's all I had to say about NFTs. I just wanted to come back to a couple of issues that I thought were particularly interesting that may be applicable to cryptocurrency. So I imagine we've all heard the story of the gentleman who had, I think he had his private key that was lost on his computer, and it was thrown away, and he spent all this time trying to find where that computer ended up and lost millions of dollars. So the ATO basically suggests that if you've lost your private key, then it can't be replaced, and you may actually be able to claim a loss, but it will depend on the circumstances around whether you've claimed it as income prior, or if you've claimed it as a capital gain, or if you've done it as a investor, of course. And I've already mentioned that a personal use asset, so if you're claiming, if you've purchased it for a personal use asset and you have a loss, then that's not going to be something that you can write off against other capital gains. So all of those circumstances will depend on whether you can actually claim it against future capital gains. And that's usually how you're going to be looking at it, because it will be a loss of property at that point. Something else that I thought was interesting, and I'm going to wrap up on this on the next couple of slides. I thought this was particularly interesting around residency issues in cryptocurrency, because just to give a bit of context, so the Australian government, of course, they only have jurisdiction to tax Australian residents or Australian sourced income. And, you know, some of you may think that, well, in that case, we could end up paying tax twice if we're not an Australian resident, but we have Australian sourced income. But there are a number of tax treaties in place that prevent that from happening. There is, you know, this general idea that taxing things twice is, you know, pretty much the wrong thing to do. But around residency issues in crypto, it has no physical form, and your records are stored all over the world. So it doesn't necessarily have a designated location. And the rules for income source often depend on the characteristics. So for crypto source, it will likely be, I would suggest, and again, this may be something that will be clarified over time, will likely be the place where a contract for exchange is entered into. So in my mind, this means it may be possible for a non-resident who is currently located in Australia, if they enter into their crypto transactions in Australia, they may end up having to pay tax in Australia as opposed to where they are actually resident. And the reason this popped into my mind as being something interesting was because I was listening to a podcast about some US citizens who were being advised to basically relocate because they'd made millions and millions of dollars of crypto. And if they managed to relocate and pretty much show that they were no longer a US resident and they moved to a tax haven, that they may end up, if they did that before they sold their crypto, they may not have to actually pay any tax on it. But I'm not sure if that's something that they've managed to get away with at this stage. So just finally, I did mention GST a few times. So previously it was, so cryptocurrency was considered to be a commodity, which meant that it would be subject to barter transaction requirements. And this meant that prior to the 1st of July 2017, there was a risk of double taxation around GST and cryptocurrency. So prior to July 2017, the sales and purchases of digital currency, such as Bitcoin, were subject to GST. But due to the change of law, the idea of the Australian tax system, and this is the general idea. I'm not necessarily suggesting that this is the case, but it should be fair. It should be administratively simple. I'm not sure that this has necessarily been achieved, but double taxation is something that is in general frowned upon, and it is there are attempts to avoid it in many different instances. And so when this appeared to be the case, that there would be this form of double taxation, this is when it was defined, that digital currency was defined as it was in the GST legislation. And so from that period on, those sales and purchases of digital currency are not subject to GST. And I think that's really all I had to say about it at this point. I just wanted to put up the future talks for consensus. And I'll leave that with you all to have a look at, and therefore think we have a bit of time for questions.
Yeah, and there are, so why don't we do the next talks and then we'll do the dozens of questions that are in the chat, and I'm sure there'll be other questions, but if you just maybe flick to the next slide or so.
Yep.
Yep, brilliant. Okay, thank you. All right, so yep, there are 3 future talks on the screen. There is a 4th one that is on, must be something like August the 18th, which is in the midst of being solidified and worked out. But these are the forthcoming talks. So one's on WACU, which is a communications mechanism. And then we're going to hear about the ZK rollups on Ethereum using Starknet by Tom Brand, who is from Starkware. And then in September, we're going to hear about bonsai trees. But so they're the future talks, but I know there are at least a dozen questions in the chat. So why don't you stop sharing your slides? So, and would you like me to go on point and work through them, or would you like to just run through them yourself?
I can do that. Sorry, I'm just getting my screen organized. Wow. Okay. Oh, we were talking about herd immunity. So that's what the first question about.
Yeah, I think you can skip the herd immunity. I think yes, at 12:41 p.m. according to my chat anyway. So I put in one about, so when you were saying not denominated in a country's currency, there was a definition of being cryptocurrency, and one of them was that it couldn't be denominated. So Tether and DAI, they're denominated in US dollars. Mm-hmm. So does that means that they're not cryptocurrency essentially?
Essentially, but I'm not entirely sure what that would mean in terms of the tax treatment. I think it would still be considered. I mean, if those are, I don't know how those are derived, Peter. So maybe you can. Are they mined just like Bitcoin?
No, and in fact, I think Sly wrote something really good, but Sly, who's probably still on the call, and I'm searching around for him in the mini screen. Maybe Sly's had to drop off the call, unfortunately, but he even wrote something about DAI and Tether just there. So he said they're not specific. He then said they're not specifically denominated. They use liquidity reserves to try and follow values. So they're close to 1-to-1, but not exactly. So essentially, the idea is that, well, at least with DAI, if I've got one DAI and then the price ends up going up a bit, or rather, the number of people who want it increases, so hence there's more demand for it, then the price goes up, and so then people are incentivized to create more of that currency, and so then the price goes down. And equally, if there are more people who've got it than need it, then the price goes down, then people are incentivized to convert it back to Ether, and so it's a self-settling currency. Wow. Whereas Tether, I'm not sure of the specific mechanism they use, but so there's Tether, USDT, and a whole lot of them where they're US dollar based. But anyway, maybe take that one on as.
Well, yeah, I was just going to say, Peter, because one of the principles of taxation, of course, is that there does need to be some form of real gain in order for it to form part of income tax. So you actually have to be making some money somehow, and it wasn't sort of occurring to me how you would make money from.
Yeah, well, and that's the point. You wouldn't actually make any money. Yeah. So normally, what people do is, so I did a spectacular fail with this sort of thing. So I converted my ether to DAI at about $1,000, figuring it was going to go back down. And then, of course, it went up to about $4,000. So, yeah, but you're essentially locking in the currency at that point.
Right.
So Mark Staples at 1242 said, so if you staple a right or privilege to a parcel of digital currency, does that make it not a parcel digital currency?
Well,
Mark?
Well, I think in the talk you said that digital currency is not allowed to have rights attached to it to do things or something like that. So my question is,
anything else?
if you staple some of those rights or entitlements to something that would otherwise be digital currency, does that make it all of a sudden not digital currency?
I think it would depend on the circumstances around it, but the big issue with that digital currency definition is whether it's going to attract GST for the sale of it, because it's Bitcoin, and I think there was a issue of Ether. Peter, you mentioned Ether. I think it's specifically referred to as being digital currency in that definition. And the idea is, because it's digital currency, means it doesn't attract GST when you buy and sell it. But if you buy and sell some form of good or service, of course, it does attract GST. And I can't speak to, the VAT in other locations and how it would apply there. But that's the premise behind digital currency. So if there's some other right, and I guess it would depend on what the circumstances are around that. If you're assigning a right to something that should have GST assigned to it, then it's not going to fall within that digital currency. And if you do have rights to something else through owning that digital currency, then it can't fall into that definition.
Yeah, I'm thinking of kind of colored coins, for example, in Bitcoin, where you can sort of, and a physical analogy might be, if I take a dollar note, $10 note, and put a stamp on it in the corner saying the bearer of this gets my car in 2 years' time, then that's an extra kind of right or something associated with that piece of money. But would that stop it being digital currency if I did the same thing with digital money?
If you, I suppose if you did that, then it would entitle them to own your car. So it's giving you a right or privilege to something else, and therefore couldn't fall within that definition of digital currency. Yeah, it's pretty clear on that point. That's why, obviously, NFTs, which gives you this right to something else, which it kind of does my head in a little bit, thinking about NFTs giving you a right to something that can be replicated, but the NFT can't be. That, of course, is not going to come into that definition of digital currency. I'm not quite sure how NFTs are treated by GST, though, and that's something I have to look into just in case that question's coming up.
So the next question here is actually by me. I got in too early, two questions nice and early. So the next one is, so you were talking about gift cards are not digital currency. So a lot of the ICO era currencies essentially said, look, we're a gift card, essentially. And so Ether, for instance, is a gift card. It says, if you've got some Ether, then you have the right to use some gas and do some work on the Ethereum blockchain. So you can execute some computer program on the Ethereum blockchain by virtue of having that Ether, and you can spend some of the Ether. And so that's how they got, so they were one of the first coin offerings where they launched and they said, no, we're not giving people a part ownership of the whole Ethereum. We're giving you the right to do something. And so if Ether is thought of as a gift card, does that mean that it's not a cryptocurrency?
I'm just kind of looking that up, Peter, because I thought that it specifically mentioned in relation to digital currency as being one of the examples that falls within it. So on the ATO site, it gives the example of Ethereum as being digital currency. So somehow they're getting around that definition, I suppose.
Yeah, well, probably by just explicitly saying, independent of the definition, Ether is a digital currency.
Look, I should go and have a look at the legislation, obviously not right here and now, but having a look at the legislation, sometimes it's things like that, but they've given the specific example of it falling into that digital currency. But, you know, the information on the ATO website is not necessarily legislation, so it could be wrong.
Yeah. Well, that's true. It's yes, as I've learned. Yes, a web page is not law.
No, even when it's put out by the ATO.
Yes. Yeah, I know. Anyway, yes. Governments can put whatever they like on their websites, but it's what's in legislation that's important.
There are certain things that you can rely on, but those are the rulings that the ATO puts out, and that's not what they've got on their website. That's just general information.
Yep. Yeah. All right. Sorry, I've got to take a call. So,
Sure.
Yeah, just a sec. But anyway,
I can go through these. Surely a currency can be a fiat currency, even if it's under a gold standard, main thing being declared by government to be a currency. I'm not an expert in all of the fiat currency and the definitions, Mark. Perhaps, yeah, that's something that I'd have to take up with Simeon, who is far more well-versed in that area than I am.
Yeah, no worries. It's a kind of side issue. Thanks.
No worries. So Greg, if someone was to buy ETH with AUD, it goes up 20% in a week, and that someone purchases an NFT a week later, would that 20% increase in ETH be a taxable event, even though the ETH is now put towards an NFT? Yes, it's an exchange for a different, form of crypto, and therefore it most definitely would be. That's a taxable event when you dispose of the ETH. So any disposal whatsoever is going to be a taxable event. Although Peter and I were talking at the start before 12:30, we were talking about the idea of when you exchange it to yourself. And in those instances, I think you're going to be okay, because you're the individual taxpayer and you haven't disposed of it to anybody other than to you. But if you perhaps transferred it to your partner or a friend, then it's definitely going to be a disposal, and any disposal is a CGT event. Yeah, Mark, you answered that one for me. Thank you. On the basis that crypto is a CGT asset, when do DeFi transactions, say ETH to get DAI on Oasis and then replay DAI to get ETH back? Have I disposed of ETH for CGT purposes at the start and reacquired ETH at the market value at the end? Yes, that would be correct. But of course, if it hasn't gone up substantially or gone down substantially, then it's not that big a deal. If it has gone down substantially, then you're definitely going to be wanting to keep records of it, because it may be a capital gains tax loss that you can offset against future capital gains. And so, yeah, you definitely need to keep records of those sorts of things. So I think we've touched on Tether and DAI, and
So the proof of stake thing and staking. So normally, if I want to lend someone some money, I'll give them the money, and then later on they'll give me back the money and some extra money.
Yep, interest.
But with staking, in some forms of staking, I don't actually give the money to another party. I just kind of lock it up and make it unable to be spent for some period of time.
Okay.
And then later on, someone gives me some money for having done that cryptocurrency.
Yeah. Mark, it sounds to me like it would be treated very similarly to interest, like a bank account where you lock it up in a term deposit and you get interest on that. You have to pay income tax on the interest itself. If the value of your stake goes up as well, then that's going to be your capital gain, but it's just going to be ordinary income is the interest on it. So I think being paid that money for locking it up sounds to me like it would be ordinary income, not going to come under the capital.
Yeah. I guess my question is, okay, thanks. That answers it.
Does that make sense?
That's interesting. Can I just jump in there? Because that's often on a daily basis, you're getting an accrual of income Is it the market value each day that is your income?
If there's no other way to show valuation of it, so how does it actually happen, Richard? So you'll have to explain it to me. If it's a matter of do you get additional crypto and that then goes into your wallet? Is that how it works?
On ETH2, for example, you have a essentially daily earnings, and every now and then you happen to be paid more because you've sort of nominated, you've been more involved in the staking. So it goes up and down, but it is daily, and market value is daily. So, I mean, I guess technically you can't pull it out, but at some stage it'll come in as Ethereum that you could sell. So I guess it's going to be a very complex capital gains calculation on that asset.
Yeah, particularly, is it something, if people are doing it as a business, then it should technically be income, but if you can't access it, then it's not going to be considered to be money or money's worth. So you remember I was talking about that at the start when I was on about markets and money. And for you to be declaring ordinary income, it needs to be convertible to cash. If it's not convertible to cash, then you're going to have a different issue, and it may end up coming under your capital gains tax regime. But it does sound like it could be particularly complicated, and hopefully there's good records that are kept of all of those sorts of things. So it's more simple than having to go back and do your own individual audit.
Yeah.
But are you saying essentially that you lock up the initial stake, and that kind of just holds its value? It might go up and down, in which case it might have its own CGT things at some point. But then later on, each of the bits of daily money you get, it's not like that's just you acquiring. Someone's giving you essentially some new cryptocurrency. And so that's
that Ethereum every day is a different value.
Sure, but that doesn't matter. People can give you different amounts of money every day. It's just you acquiring an asset that will then have its own. This is the start of your holding of a capital gains taxable asset.
So Mark, so let me ask you this: it's something that's coming in on a daily basis, so it is like an income flow. Yeah, like to me, and it sounds like if it's something that's happening every single day, then it is going to be considered income, much like interest on a bank account or being paid dividends on owning shares. That's what it sounds like to me. I mean, I could be wrong because I'm just, sort of going from your description and off the top of my head, but it does sound to me like that will, if it's convertible to cash, then it will need to be income. If it's not convertible to cash, then it is going to form part of your CGT asset, I would imagine, and it's going to potentially increase that value.
I would have thought surely it's got to be a CGT because so people put 32 Ether in, and the whole idea was to help bootstrap the next phase of Ethereum. And so a whole stacks of people all around the world have put 32 Ether in. And they've locked it in and they're getting daily rewards, as Mark and Richard are saying. But the issue is that it's locked there until Ethereum 2 goes completely live. And it's not going to go completely live until probably, January, February, March next year, sometime Q1. So it's not liquid as far as able to be converted to, say, dollars until then. So independent of the daily rewards they might be getting, essentially you put it in 32 and then maybe March next year it's 34 ETH, say, and at that point it feels like you've got 2 Ether gain and whatever the dollar amount difference is for the valuation. But I don't know, maybe I'm not a tax lawyer at all. So
No. Look, that's really interesting, and it might be something I have to take on notice to go and have a look at. But if it's not something that's convertible to cash, then that's going to preclude it from being something that you have to declare as income, because it does have to be convertible to cash for it to be ordinary income, unless, of course, there's a statutory provision that says that is income tax, in which case it doesn't matter whether it's convertible to cash or otherwise. I'm not aware of one that says in those circumstances, and I would be very surprised if I could find one. So in that particular instance, then it would probably end up being looking at adding value to your CGT asset, in which case, until you convert that, until you dispose of that asset itself, it's not going to be a taxable event.
But when you say convertible to cash, this is actually in Ether. And so do you regard Ether as being convertible to cash?
Oh, my understanding of it is that you can trade it at any point, can't you?
Through an exchange?
Yeah.
Yeah. So that counts.
But this, I think, Mark, what you've got to think of is you converted Ethereum 1 Ether to Ethereum 2 Ether. And I think that's a way of maybe couching it, is thinking about, I mean, you've got, I don't know, Ethereum 2 Ether, which is all going to become normal Ether again back in, I don't know, February next year. But until it's become normal Ether again, it's special Ether.
Yeah, no, that's not my question. And that's another whole other level of complication. My question was just about staking within the same cryptocurrency environment, whereas you're talking about the transition of a platform from one kind of rule base to another. And what does forking create 2 new cryptocurrencies or not? I don't know. I mean, this is all a separate kind of question.
I do have some notes on forking and taxation. I just don't have it at the top of my head, Mark, because there are issues around forking and taxation. But it depends. Again, it depends. Like I said, it sort of comes back to the principles around taxation, and it does require, for there to be income tax, there needs to be some form of flow. So you need to actually be getting some form of a gain. And a fork, doesn't it depend on the circumstances of the fork? And you'll have to excuse my ignorance on this. Do you get something for nothing in a fork, or is it basically that you get nothing for nothing in a fork?
You used to have one Australian dollar, and now you have $1 Australian plus $1 and the $1 has some amount of value.
Right. Right. So you do actually get something in a fork, which would mean that there would potentially be some kind of taxation implications around it. But if you're not converting it to cash, whether that would be you acquiring an asset or being paid for something would depend on the circumstances around it, I imagine. It
would be like a share split.
Probably treated a similar way. And I think that's the way that they've been treated traditionally is in a very similar way to shares. Even though it's quite different.
The same, and you just split it over those assets.
Can I just get back to the one about staking? If it's treated as income and based on the Australian tax rules, it actually has to be converted to Australian currency. So does that mean that you've got to convert it on a daily basis to the Australian currency?
Can you explain that again, Fleur? Like it has to be converted.
Yeah, so if it's treated as income, whatever you gain in your coins on a daily basis, do you actually have to convert that on a daily basis to whatever the AUD currency is?
No, Flo, that's not the case with income tax because it is convertible to cash. It can still be taxed at its market value if it's coming into you on a daily basis, particularly because there's some frequency around it. So ordinary income usually involves some form of frequency, it's some form of gain. Yeah, and there's a flow of that income. It doesn't need to actually be convertible for you to be acquiring something of value, because you can potentially hold on to it and it can increase in value and you've got a separate event for that. So it depends if it's a business situation or if, of course, if you're a sole trader. I think somebody mentioned that in the chat somewhere. If you're a sole trader, then you have to pay income tax on each one of those gains as they come in, even if you don't convert it, to fiat currency at the time. And if you're in Australia while you're making those gains, or if you're an Australian resident, then you'll have to pay it in Australia.
Okay, thanks.
So I'm conscious of the time. Peter, did we want to go through, are there some more questions that we should go through?
Why don't you look at the top 2 questions that you think would be interesting to answer, and why don't you answer the top 2?
Okay, let's see. There's another Diane Tether one that I feel like I'm not well placed to be responding to that. Getting the ETH daily rate is not difficult. I think there's a lot of comments in here.
Yeah, I think that was my take. I was scanning through, trying to, and there was one about swaps and DeFi, and I'm just looking at that, and I'm thinking, I think you're going to want to go and talk to a tax accountant who's going to specialize in this sort of stuff potentially.
I think the nature of this conversation has told us that going to just any accountant is probably not going to be terribly beneficial. You'll have to go to somebody who's specific to crypto if it's something that you know, you're either trading in or you're working in on a daily basis.
Absolutely, yeah.
I'm not entirely
my
sure.
tax accountant doesn't know any of this sort of stuff. That's why I'm actually having to go and find out the information for her.
Yeah, well, that's exactly right. They won't have, I mean, and it's also new, you know, it's not necessarily, you know, I don't want to start slinging off at some of the accountants out there, but it is all reasonably new, and it is all reasonably complicated. So, yeah, I'd be surprised if there were many people who really specialized in this area.
Yeah. All right. So, how's about then we leave it there? Because I think you've answered lots of questions, and I think we have all learnt a lot. So, which is awesome.
Like I have too, Peter.
There's so much to learn, though. And so, look, thank you very much. It's been awesome to have you on the meetup again. And I think in another year or 2, you're going to come back with another talk. And yep, so I guess we'll be seeing you in 2023. Actually, you're saying that you're going to be probably with us for 2022 at the Supply Chain and Blockchain. So that'll be awesome too.
Yeah, well, like I said to you, there were some other things that I was super interested in the supply chain and blockchain, particularly what's going on in the UK right now, where they're trying to do away with any paper-based trade. So, yeah, I'm really interested to see what happens there. So, yeah, it might be something that I can talk about in a year's time.
Sounds good. All right. So thank you, everyone. Have a great day, and talk to you all later. Bye-bye.
Thanks, Peter.
Thanks, Christy. Bye.
Bye.
Bye. Thank you. Bye.